Good morning everyone and welcome to the Prescient Investment Management Responsible Investing webinar. My name is Natalie Anderson. I am part of the business development team and I will be facilitating our discussion today. ESG, or environmental social governance, has taken the world by storm. The push towards sustainability is influencing our daily lives and filtering through to the decisions regarding investment. The asset management industry has become increasingly focused on incorporating ESG factors and addressing sustainability. But as investors look for ways in which their investments can make a positive impact, navigating this new environment can become challenging. Today we will be discussing Prescient's views on responsible investing and how we embed sustainable finance practices across all levels of the company. With me to discuss this today, I have Conway Williams, who is our Head of Credit and Portfolio Manager, Michelle Green, who is our Credit Analyst and Chair of the ESG Committee, and Shriya Roy, who is a Quantitative Analyst. At Prescient, we see ESG on a holistic level. There are three initiatives in particular that we focus on, being corporate, investment process, and product development. So Conway, would you be able to take us through how we view responsible investing and maybe a high-level overview of the three pillars that we look at?
Sure. Good morning, everyone. So I think you hit the nail on the head there, Natalie, in that we see responsible investing as a holistic approach at Prescient. What we do is we embed responsible practices or sustainable practices in whatever we do, from creation of products to how we embed it in the investment process, or even in terms of how we improve market standards. So with that in mind, let me talk about the three pillars and give you a bit more detail on it. Firstly, it is obviously in our investment process. We embed ESG in everything we do, whether it is in an ESG type product, an impact product, or an SRI type product. That is important. We see ESG as a risk tool, which allows us to consider actual risks holistically from both a quantitative and a qualitative perspective. So when you've got these working together, you can understand you can actually consider risks much better and, again, holistically. And I think the important part of embedding responsible investment practices or sustainable practices through the use of ESG is that you are actually discharging your fiduciary duty appropriately. And that is, again, looking at the numbers, looking at everything from a quantitative perspective appropriately, but then also having a qualitative overlay, which is very, very important. And especially where you have more bespoke type opportunities, you actually need to have these working hand in hand. The second pillar that is very important to us is obviously from an engagement perspective or an improving market standards perspective. And that is where we are signatories to various industry initiatives. Examples of that, and Michelle will probably touch on that in a little bit, is CRISA, UNPRI, and various other initiatives to make sure that we are part of the entire process or considered thought leaders in this process. And then the final pillar, which is obviously what we're very excited about in terms of what's going to be happening in our lives going forward, is actual ESG impact or sustainable product creation. At present, we have two products. One is our clean energy product, and the second one is our infrastructure project, which we'll obviously touch on a bit later. But the creation of projects and products allows us to actually live the corporate ethos that we intend to live at Prescient. Importantly, we want to meet client needs in terms of creating development type products. We want to create products that actually achieve impact. And whether it is from a job creation perspective or a COP26 or an environmental perspective, we want these type of products there to actually show that we're putting our money where our mouths are, that our corporate ethos is being lived in terms of improving market standards and adding to the developmental narrative, and very importantly, doing that without actually compromising returns at all.
So in terms of that corporate ethos, it really is embedded across everything that we do, just filters all the way down. And that's quite a huge undertaking. So that's why we have an ESG committee. So Michelle, as the chair, could you take us through what the committee does and some of the responsibilities?
Thanks, Natalie. So from an ESG committee perspective, so the key thing here is that we have key stakeholders across the business, as well as representatives from all the asset classes within our business. So by way of demonstration, let me show you. As you can see, we have Shriya, who is our CEO, as well as Bastian, our CIO, and we have representatives from all asset classes, that being, for example, Conway, who is head of credit, but also Natalie, who is from the business development client-facing team, as well as some quantitative analysts, and myself working alongside Conway. The role and responsibilities of the ESG committee is to drive the objectives of the broader organization, but also with regards to how we employ our responsible investment philosophy. We are here to also engage with stakeholders across the industry, but also investee companies. We not only do that, but we also monitor the developments within the ESG space so that we are able to actually have an impact across the organization within our products and with our everyday investment decision making.
And I think having such a diverse mix of people really adds a lot of depth to the team, because we all kind of see ESG in different ways and everyone brings different perspectives to the table. So earlier we were discussing how we embed ESG across our entire investment process, and I think as a systematic manager we have quite a different way of doing this, definitely compared to other players in the industry. So what we've done is we've developed our own tool to be able to assess companies. So Shriya, could you take us through that?
Sure, Natalie. So we've developed our own in-house scorecard, which helps us to assess risks and potential investment opportunities. And the goal of the scorecard is to achieve an ESG score for every company that we look at. And we're mainly focusing on the South African context here. So this score is made up of, no surprise, the three main factors, E, S, and G. And we break down these top level factors into sub-factors, and then we break down those sub-factors further into 62 underlying metrics. But this can be quite difficult to visualize, so I think it will be easier if I show you. Okay, so these are the top level factors I was speaking about in the center circle, and then the sub-factors are listed on the outer ring. So for example, let's start with governance. Why do we care about governance? Well, we want to know that the companies that we're investing in have good governance policies in place, because essentially this will mean that they're more ethical and more professional. So we can look at things like diversity, and this can include looking at the percentage of females on the board. We can also look at board structure, which includes things like the percentage of independent directors on the board. Now, if we turn our attention to the environmental aspect, more and more companies are becoming aware of things like COP and net zero goals, and organizations like the TCFD have developed a framework for companies to report on their climate risks and opportunities. In keeping with this theme, we think it's fitting to look at the environmental aspects of a company. So we can look at energy. How much energy is this company using? How much water are they using? Do they recycle? Have they emitted any greenhouse gases? Do they have any policies that are supporting any of these? Then we can also look at social aspects, which essentially means, does the company care about its employees? So when we look at employees, we can look at diversity. When we look at safety, we look at, is this actually a safe place to work? And then we can look at policies, which includes things like, are there fair remuneration policies in place? Now, all of these factors essentially would lead to impacting financial returns, or they would have financial implications. So that's why we feel that we need to actually dig deeper and to actually drill down into these factors and look at them from this level.
Okay, so you've mentioned a lot of metrics. Where's all of this data coming from? How is it feeding into the scorecard? And more importantly, how are you processing such a large amount of data?
That's a good point. So in keeping with Prescient's philosophy of being a systematic manager, our ESG scorecard follows suit. So it is a rules-based approach and it's heavily data-driven. So we are looking at over 200,000 data points for ESG data, and all of this data comes from integrated financial reports. Okay, and this is across all the companies that we rate. Now, this data is stored in a database, because obviously we've got to put it somewhere, and it's managed and supported by our dedicated data science team. What this allows us to do is, well, what having an automated process allows us to do is to focus more on improving the process and not worrying about day-to-day tedious tasks. Another reason why we like this data-driven approach is because it essentially means that any decision that we make is made on the fact that the evidence has already been presented in the data. So we're not being swayed by how good or how bad we feel about certain companies or topics.
And ESG can be quite an emotional topic. People feel very strongly about certain things. So I think in that regard, it's really a key advantage to have such a data-driven, systematic process. And also, we are able to take such a deep dive into the different companies that we look at. So could you maybe give us an example of one specific company and show us how that score actually looks in practice?
So I think it's always easier to tell a story by looking at a picture rather than me just saying a number. So I'll show you. Okay, so this is an example of our dashboard. Now we have this dashboard for every company that we look at. So let's look here first. This shows our overall ESG score. For this specific company, Clicks, the ESG score is 0.8. Our internal ESG scores rank from 0 to 1, with 1 being the best. What we can then do with this top level score is break it down further and look at the individual drivers. So we can look at how much is environment, social, and governance contributing to this top level score. And from what we can see here, we see that governance is actually the biggest contributor. What we can then do is track these individual scores through time. And this is what I'll show here. If I just switch off some of these so we can focus on one factor in particular, you'll be able to see that we can look at these scores on an absolute basis and on a relative basis. So we can see how is this company doing on their governance relative to the peer average, which is the dotted line, and how are they actually doing in comparison to themselves. What we can see here is that there's been a trend upwards and they are actually above the peer average. Now, this will then make us think, why is this happening? And then we can drill down further into our data. And the reason why, or rather one contributor to the fact that their governance has been increasing, is because their board structure has improved. We can then drill down even further into some of the sub-factors I mentioned earlier, and we can track these through time. Now, if you look at this map, the more red the score, the worse it is. The more green the score, the better it is. So if we see scores going from red to green, it means that there's been an improvement in this space. And as you can see, our data goes all the way back to 2008. So we do work with a lot of data. We're not just basing our decisions on data that's got a short history.
Thanks, Shriya. So I think it's really important to note that all of the data we've just seen is being pulled in from the integrated reports of the company, as you mentioned. And those reports are in a PDF version. So we've actually spent many, many years building our tools to be able to pull this information from the PDFs and backtesting this data and really making sure that we've taken any of the manual, tedious tasks out of getting this data, which is pretty impressive. And then one thing I wanted to ask is, you were showing us the company against the sector, but obviously different sectors have different areas that they will focus their sustainability efforts into. So how do you address this? Are there materiality considerations when looking at your ESG score?
So that's a good question. When we look at the top level factors, so the E, S, and G, we weight those on a sector-specific basis. So we account for sector materiality as well as company size biases. And now in addition to that, when we're looking at the sub-factors that I showed you, those also are weighted according to how important they are in a South African context. So let's take, for example, a basic materials company like Implats or Exaro. You would expect them to have a higher environmental impact, versus when you look at something like a bank. So that's why we would weight the E score more heavily in the basic material space.
And I guess then for the bank, the G would be more heavily weighted because in the financial industry, it's so regulated and governance is such a focus.
And I think just to mention, just on the social side, if you think of it from a retailer's perspective, it's very close to the consumer, but the employees play a very pivotal role in the operational side of that retailer. So the S would be quite key there again on the social front, but also on the environmental part as well. Is how is their supply chain actually managed? Where are they getting their products from? What are they doing with the waste? So that's also a key contributor that we look at.
I think that's a great example, and it's so impressive to be able to see that data at such a granular level. However, I know that there are challenges at the moment in terms of disclosure and reporting because there's no set standards or guidelines for companies as to how they should report and what they should be disclosing.
Yeah, so definitely in the South African space, it is quite challenging right now because, as you mentioned, there are no set standards yet. But, you know, when we look at this data, we do see that there are consistencies here and there. You know, so sometimes companies will just stop reporting on things like their employee turnover or things like whether they are emitting indirect or direct carbon emissions. So it is a work in progress though, and what we are doing at Prescient to actually help this process is to promote transparency by engaging with industry bodies like ACISA and the UNPRI, and Conway and Michelle are representatives at ACISA, so we really make sure that we are actually part of this process. And you know, we can't be too negative about it. We look at 10 years ago or so, it was really hard to get a hold of this ESG data. But looking at the years, we've seen that there have been an increase in the number of data points. So we're moving in the right direction, but there's definitely a long, long way to go.
And I think, Natalie, just to add one point to that, we take investor company engagement very, very seriously. And as you mentioned up front, ESG can be a very emotive topic. What we do as a systematic investment manager is we try to remove that emotion. We built processes, as you said, is back tested. And we can actually see, for example, if somebody stops reporting on a specific factor, we can have a data discussion with that management team to understand what happens or what has happened. So yes, from a risk perspective, for example, in Michelle and my space on the credit side, we can understand what's happening, how that would impact our default probability assessments and the like. But then also when you have those engagements with the counterparties, you're actually making positive strides from an industry perspective. So while we're at the CISA level, we also have this discussion with the investor companies, and you say, listen, we're actually watching you. And we will deploy capital in the appropriate manner to entities that report and are more transparent or actually disclose better or more information.
So essentially you are holding them more accountable.
And we're improving standards, whether it is through, as I said, industry bodies or at that level.
And that's important because we want to be able to make informed decisions. We want more information. Knowledge is power, as they say.
And remove the emotion.
Yeah.
So have a data-driven discussion with the management team, showing them what we found, and then not actually getting lost in maybe a fluffy story.
Okay, so we've built this systematic scorecard. We've pulled in all this data. We've gotten an ESG score. What next? How do we bring this into our investment process?
Thanks, Natalie. So I think the best way to do this is actually via demonstration using our internal portal. So what's important is that here at Prescient, we employ a quantitative, risk-cognizant approach when we do asset selection or asset allocation, when we price for credit, as well as the manner in which we manage our credit portfolios. So by way of doing this, we employ an internal credit rating framework which has 3 key models, that being Altman, KMV, and the credit scoring model. This all filters into a credit rating ultimately, and that gets overlaid with our ESG notching approach. So if I can break it down in the sense, so what happens with the ESG score? So as Shriya mentioned, we use all this data, we get a score, and what happens to the score then is it falls within these bands here on the left. So this score will be able to tell us in which quintile the company actually falls. So for example, if the company has a score of 0.3, it will fall within the second quintile. What that essentially means, it gives us an indication of how many notches does the credit rating actually get impacted by. So that means we need to notch this credit rating down by 1 notch. For example, using our credit models and taking into account our ESG assessment, that means a company that is rated A+, for example, taking into account the ESG assessment, we'd have to notch it 1 down. That means the company now rates at A flat. Essentially, what we're trying to do is to capture what is the risk. And the risk is indicated by a probability of default, which in this case is defined as what is the chances of a company not being able to pay back their debt. the rating or the probability of default is translated into a credit rating, which is a credit risk assessment of any given investment opportunity.
Okay, so what we're doing is we are getting our own credit rating or probability of default from a variety of different models and some of our own inputs. And from there, we are taking that ESG score and plugging that into the model. And basically, that leads us to the final or overall credit rating or probability of default, which is reflecting then all the risks inherent in that company. So maybe as an example, you could show us how this ESG overlay works in practice. How does it actually affect how we look at the investment?
Thanks, Natalie. Again, I'll demonstrate via our portal. This image over here is a demonstration of the probability of default, as you can see here on the left, and our information that tracks it over time. So importantly, on the top here, we have, as I mentioned, our three credit models, being credit, Altman, and KMV. For the purposes of this demonstration, I'll just tick them off. And what I'll showcase here is the dark blue line is actually our credit rating output of those models, and taking into account our ESG analysis, it then gives us an overall rating being the light blue line. So by way of demonstration, you can see during the period of year 2020, this was quite heightened. The probability of default for this specific property company was quite heightened. This is demonstrated by quite a high probability of default, as you can see over here. Now, given with more certainty as things have evolved over time, the probability of default has actually tapered down. What then happens is that we are able to assess what the risk level for this company is. So as you can see, from 2020 being a 9% probability of default, has now tapered down all the way to about 2%. So taking into account our credit models before we take ESG into account, that probability of default translates into a rating of PAA, meaning AA flat. However, taking into account our ESG analysis, this translates into a one-notch downgrade to a AA minus, demonstrated over here. As you can see, the probability of default has increased by 2.13% to 2.63%. So at any given point in time, we'd be able to assess a company's risk measures and incorporate that into our analysis on a day-to-day basis. So some of the factors contributing to this risk that led to the one-notch downgrade actually had to do with governance, for instance, where there was lack of independence on the board, but also diversity also played a part, and lack of disclosure with regards to the environmental initiatives, specifically around water and wastage. So this all factors into the risk, and this is captured into our credit rating.
So I think the important part that Michelle is illustrating is that the data that we use and the output that we achieve then again allows us to have discussions with that specific counter. As you could see, had they actually met their targets or met the targets that we believe is important for them, there actually wouldn't have been a difference between our default probability assessment rating using our quantitative models and our ESG score. So now what happens is we have a discussion with the CEO, the CFO, or even the board to say, what's happening with your nomination committee? What's happening with your remuneration committee? Why do you not have diversity on the board and the likes? And they can't actually say, we have those, this is the data, this is how we've scored you, you've done well historically, now there's been a step change, and we now have to actually penalize you from a pricing perspective because of this added risk. And I think that is very, very important to have a data discussion showing them what we've actually seen, what has happened, and how this has alerted us to potential added risk or increased risk within an investment that we have or potentially will have.
I think the key as well is that our models are actually updated every day. And so with that in mind, we are able to make investment decisions quite efficiently in that regard.
Okay, so basically, if a company has a poor ESG score, this translates into a higher probability of default and therefore higher risk. So if we had rated them AA, for example, we would then notch them down to an A rating. But the key is we would still invest in that company, potentially, but Michelle, you can get into that later. But we would require a higher rate of return to compensate us for that embedded ESG risk that we've identified.
That's correct, Natalie. What is key is that the probability of default will tell us at which scale of risk is this entity sitting at. So the higher the probability of default, as I demonstrated earlier, during the 2020 period, it was quite heightened. So with higher risk, we as investors, naturally so, we would require a higher rate of return.
And obviously, we're not doing any type of negative screening where we would specifically not invest in an investment because of a poor ESG score. So how do you actually make sure that you are adequately compensated? How are you looking at your return requirements in terms of the probability of default?
Right, so as I demonstrated, the rating does capture that elevated risk. And with that, we are able to price accordingly, depending on where they fall within that scale. And again, I'll demonstrate our pricing curves of how this actually gets assessed on the ground. So what this graph over here shows is our internal pricing curve as we looked at on the AA scale. So what it shows is the spread of a given investment bond and relative to its term to maturity in years. So what we have, the dotted line here, is what we call a fitted curve. That indicates to us what is the minimum spread or rate of return that we require for any given opportunity when we do make an investment decision. So all the bubbles sitting above the curve in this case would screen a buy opportunity. Any investment bubble that sits on the curve actually can indicate a hold, or even, depending on the size of the bubble, will be then indicated whether it should be a hold or a buy strategy. Anything below the curve does not show value. It's actually too expensive to buy, so we would not invest. It can either indicate not enough value or a sell opportunity. So importantly, just to bring it back, as I noted, our rating incorporates the ESG risk assessment. And these bubbles that is indicated here, or bonds for that matter, are priced according to that measure, taking into account our ESG risks as well.
Thanks, Michelle. So we really have embedded ESG across our entire investment process, from the ESG score to the credit rating overlay to looking at the risk return requirements. But we want to take it a step further. So what we've done is that we've developed our own impact investing funds. So Conway, could you take us through these funds? What led to the creation of these products?
So I'm going to start with the last part of your question in terms of what resulted in the creation of these projects or these funds. The first part is that we have a corporate ethos of deploying capital into initiatives that not only result in economic growth, but importantly, economic development. These type of products actually have positive benefits in terms of either job creation, supporting a potential net zero, or environmental considerations and the likes. And also, if you just consider client needs over the period, you can understand why people are needing products that actually either contribute positively from an E, S, or G perspective. So that is the first part. Now, we were at a point in time between 2011 and 2013 where the South African Renewable Energy Program was commenced within South Africa, and we believed that we could contribute positively. We had a situation where we had a utility that was not meeting the needs of the country, and we also had climate objectives as a country. And we felt that we could put together a product that actually assists with both. And that is the genesis of the clean energy projects, or the product that we have created. We've been very successful in terms of the number of products or projects that we have been able to include in this fund, and very importantly, actually achieve commercial returns while creating that sort of impact story. The second fund is obviously our broader infrastructure fund. And if you just think of the role of infrastructure in, again, the economic growth and developmental story, you can understand that a country cannot function if it doesn't have the appropriate infrastructure in place. Can you ship your goods and products if you don't have roads or rail or ports? Can you actually treat a nation for example, that has just gone through a COVID crisis if we don't have the appropriate hospitals? Can we improve the level of education if we don't have schools? So again, it's going to our corporate ethos of creating products that actually contribute to the development of the nation and then ultimately will result in an improved economic growth story. So that is it. It's a corporate ethos story. It is delivering on client requirements because clients have been calling for more and more real tangible investments. And then if you just think of these projects that we are investing in, it is natural for an actual retirement or a retirement saver to want to have long-dated projects that are actually uncorrelated with your vanilla or traditional markets. So again, if I'm giving you an example of what we've just gone through, one of the worst crises around, and these projects that we've invested in have actually shown so much resilience, much better resilience, less volatility than any of your traditional asset classes. And you would think that there would be, because they're very complex type instruments, that there would be volatility or credit type events. We've actually seen that it's come through largely unscathed. So again, creating products that contribute to economic development and ultimately to growth, and then also achieving real impact status or stories going alongside that.
And I think a lot of the projects that these funds actually invest in are really interesting. Could you take us through one of the exciting ones?
So one of the more interesting projects that we have invested in recently, and it's obviously been very topical and newsworthy with the president actually visiting the plant, is the Redstone project. So just imagine sunlight being concentrated by thousands of mirrors onto a receiver on a 162-meter tower. So it's huge, it's massive, it's actually the natural evolution of solar projects within the country in that it actually has storage capacity as well. So I think when you have solar and the sun isn't shining or there isn't enough irradiation, what do you do at night? This one actually has embedded storage for a period of time, and it's up to 12 hours through molten salt technology. So being invested in projects that actually achieve solar, again, electricity and electricity availability during the day, and now evolving so that even at night or when the sun isn't shining and the likes, to still allow electricity to be produced and be obtained, is something that we're very excited about. So again, looking at existing projects, but then also making sure that we evolve with the industry or push things to make sure that we can actually advance. And that is so the technology excites me, but I think the important part is the impact that it creates. It's a huge project. It's one of the largest of its kind in the world. And with that comes the benefits of job creation during actual construction phase, added community involvement or ownership, so where the actual projects have a community trust, which earns economic returns, which can then be used in social and economic development initiatives, and then bursary programs and the like. So there's a lot of positive intent around the project. We are then able to talk about the actual impact achieved through these type of projects as well. And that is what excites us. So technology, risk considered, and then also positive impact. And importantly, again, not giving up commercial returns while we actually create a lot of impact.
So as you mentioned, the most important part of these projects is that the impact is measurable. So you mentioned it's the development of the country, it's the upliftment of the community. Are there any other projects that we are looking at or that we're invested in that have tangible output?
Yes, so another project that's very close to Michelle and my heart is a company by the name of Africa Direct Group. What they simply do is take individuals who have impaired debt or debt track records, and they put them through an educational program. They consolidate all of the debt through using home loans or houses as security, and then actually get everyone that's involved in the project back on track to go into the formal system again. We initially piloted the project, which meant that there were probably less than 20 individuals that were in the project. And then over time, as we got understanding of the structure, got a feel with the risk profile of the actual product, we then actually deployed further capital. So over the last year, we deployed a significant amount of capital to help scale up this project. And what that has meant is that more than 100 people have actually benefited from a product that is actually helping them. And if I just give you one tangible impact note, if you simply consider a family that's earning, not one person, sometimes 2 or 3 people, earning less than 20,000 Rand a month, that's drowning in debt and don't know what is actually going to happen to the family if they're going to have food on the table next month. Yet they have a property that they can actually use and then get that property to be the backbone of a new structure that ultimately gets them off the blacklist and allows them to get into the process again. You can understand they achieve certain savings because they've now got security that they can use. Yes, it's made a significant impact in lots of people's lives in that they are actually able to use their property as security to help them improve their track records. And then again, significant amount of savings on a net basis to allow them to put money on the table, food on the table, educate their kids, and importantly go through an education program, which was the reason that they actually were in this problem in the first place.
Wow, that's absolutely amazing, really having such an impact and being able to change people's lives like that. So I think the last question, Conway, is while these projects are having an impact, and you have touched on this, do they have the ability to achieve inflation-beating returns for our clients?
So the answer is absolutely yes. For example, in our first fund, which now has an 8-year track record, we've got an aggressive benchmark of CPI plus 4.5, and we've been able to beat that benchmark over every period since inception. What we are able to do is blend assets from an operational construction perspective to make sure that we move up and down the capital stack or the balance sheet, provide funding accordingly, and then achieve those returns. And again, we also have other mechanisms that help us. For example, we have got a large team on the interest rate side that can assist us in putting products or putting initiatives in place to allow us to actually beat those returns. But the project itself, yes, we have been able to and we can.
Thanks so much everyone for joining us. We are going to take some questions now. We will be putting a poll up, so please answer. Thank you and goodbye. Morning everyone. Thank you so much for sending through all of these questions. I think we'll just get into that now. So one of the ones that we have, I think Shriya, this is a good one for you, is that there's quite an increased focus on the E in ESG, and often the other aspects of the social and the governance, those risks are being overlooked. So how important is it to look at all of the factors together and not in isolation?
Yeah, so that's a good point. If you think about the world that we're living in now, I mean, it's understandable why the E is the first thing that people think about when they talk about, or when ESG is a topic, because we're increasingly becoming aware of climate change and how important it is to take these risks seriously. And we 100% agree with that, and we think that it's important. However, the way that Prescient uses ESG is as a risk management tool. So when we're assessing the risk of your investment, we can't just look at it from one aspect. So we can't just look at it from the environmental perspective. We've got to take into account the social perspective as well as the governance perspective. And this is because it's our fiduciary duty to look after our clients' money in the best way that we can. And, you know, for example, from the social side, we have to make sure that this company's employees are looked after, so that there are good human rights policies and equal opportunity policies, because maybe in the short term, these things don't really matter, but in the long term, it 100% does, because that's the view that we take. We're looking for sustainable, long-term inflation-beating returns. And from the governance perspective, in South Africa, as an example, it's really important because a lot of the failings here have been because of governance failures. So that's why we think, you know, it's really important to look at it from all of these aspects and not just, you know, focus on one.
And I see we have another question on the SOEs. So just feeding into that governance part. Obviously, in South Africa, we have poor management, corruption, and there's been a lot of inferior outcomes in terms of these companies. So Conway, maybe you can just take us through this as our fiduciary obligation to investors. How do we look at this?
So I think the starting point is just to echo what Shriya just said. We apply a holistic approach to investing, not only to ESG in terms of how we embed it into our approach. So on the SOE front, as an example, the main issues, and we've got numerous examples thereof, was being on the governance side. Yet they are large employers, or they would contribute to developmental objectives, but the failings come on the governance side. And with that in mind, we've actually developed our scorecard to take into account ES and G issues. And then we combine that, use it, as she said, a risk management tool, and assess whether our quantitative models need to be altered based on our ESG scoring for that entity. Because ultimately, all the research that we've seen, the backtesting that we've done, is that ESG risks, while might not come home to roost in the short term, over the long term will either impact the sustainability of an organization or ultimately the cash flows of the organization. And that is how our returns are made, through those cash flows, or how risk is actually how it emanates from an entity such as an SOE. So with that in mind, we score every single counterparty, whether it is a JSE listed or a SOE. We consider the risk inherent in that investment, and we price accordingly. And that is why we're firm believers in a holistic approach, where we combine strong quantitative assessment tools and methodologies with bottom-up assessment methodologies as well. And yet, as Natalie mentioned, we've also built tools that allow us to do that in a systematic way, and also very automated manner. So it makes our job as analysts much easier in terms of, firstly, assessing risk, and secondly, having proper conversations with management teams on whether they've done the right thing, whether there's been changes and the likes. And importantly, over our life that we've been here, that has helped us in terms of how we price and how we've actually avoided certain issues in the market to date.
Thanks, Conway. So I'm seeing quite a few questions coming through on one particular topic. So Michelle, I'm just going to try to summarize this for you. So there's a lot of focus on clean energy. We've got net zero. But in terms of this, how do we, sorry, I'm just going to look at the question. Okay, so for net zero and clean energy, we've got a lot of focus towards this, but in the South African context, is this actually sustainable? We have a lot of companies or ESG portfolios excluding basic materials companies, but can we actually do this?
So, I mean, Natalie, at this point in time, specifically in the short term, it is rather a fictional perspective that, you know, it cannot be achieved not only in the short term or in the medium term. I think what is important is that South Africa, we're still very heavily reliant on coal as the energy source. And, you know, we as Prescient, while we don't have exclusionary practices, we do actively actually support the drive to having diverse energy sources, to channel the money into the right direction in terms of having more clean energy. This not only obviously has a positive impact on the economy, but also we question whether or not we can actually play a part in achieving those positive goals. One way in which we do it is to look at it rather at a risk management perspective. So whether it be factoring into or discounting the cash flows quite heavily to factor in for potential environmental liabilities in the future. So certainly, I think we support the drive, South African drive, to decommission some of these coal fleets that will drive, you know, the money towards more cleaner energy type projects, so that we can make better decisions as investors and drive the economy away from having reliable, or rather to be reliant on one energy source at the moment. So certainly in the short to medium term, I don't think that we will necessarily achieve the net zero at the moment, but we certainly can push and navigate funds towards infrastructure that is either old or, like for the SOEs, for example, channeling the investor funds rather to improve the infrastructure and to drive more clean energy type investments.
And I think we'll take one more question. So Conway, you can answer this, and it kind of follows on from Michelle. So why is there an increased focus on sustainability globally?
So I think this goes exactly to what Michelle just answered. There's been a significant focus not only on the E, but broader sustainability issues, because the exclusion of sustainability thinking has resulted in many of the failings globally, and importantly in South Africa, where we particularly invest. Shriya mentioned SOEs and governance. There are other corporate examples where governance was actually the issue. Then you're thinking on the E side as well. People simply want to know that they can make a difference. And if you think of the impact of climate change, you think of the impact that it's having on our lives, be it from inflationary issues because there's no sources of grain, wheat coming from specific regions due to droughts and the likes. People are becoming more alive to the idea that funds should be used in a positive manner, channeled in the appropriate projects so that they can make a difference, because we are here for the long term. And again, to reiterate our approach, we are long-term investors. We want to take a long-term view, and that is why we would like to channel our funds to sustainable businesses, or businesses that show a trajectory to get to sustainability.
Thanks, Conway. Thank you so much, everyone, for joining us. Have a great day further. Goodbye.